You don't know what you should be in for 2026. We're in the next industrial revolution. I think next year is going to be the year of robotics, power for data centers, automation, just going to be trillions of dollars to be made. And it's a proven fact that people who work with professionals like you and I make far more money over time and on average than they do without. Welcome to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner, Giuseppe Visconti, and we are certified portfolio managers that specialize in helping people who are retired or about to retire manage their money. As always, if you like our show, give us a call to arrange a no-obligation consultation or ask questions, or for any reason for that matter, just to say hi, I guess. Our number is 916-967-3500. Again, that number is 916-967-3500. One of the reasons why you might want to call Giuseppe is because, at the end of the year, certain portfolio strategies become more prevalent than other times of the year. Certainly, if you have positions that either have a loss or large gains, and maybe you're out of balance. Maybe those positions now, the ones that have large gains are too much of your portfolio, and the ones that have losses aren't enough or aren't the right position or should be removed. And so looking at the tax consequence of your portfolio and your strategy, you only have, here a couple of more weeks left, which I can't even believe.
I know. Time flies.
I mean, it was just 2 years ago that you joined me and
right.
and we added you to the radio show, and here we are.
With less hair.
Definitely both balder. I'm a little bit thinner than I was 2 years ago. You're a little bit thinner than you were 2 years ago, but nevertheless, it's important to set yourself up at the end of the year to kick yourself off in 2026.
Yeah, I think you're talking about tax loss harvesting and rebalancing.
Yep,
right?
Exactly. And so many people are afraid to, especially in their taxable accounts, liquidate a position that might have gains in it because they just don't want to pay any sort of tax.
Or vice versa, sell something that has losses, but they're like, I know it's coming back. I'm going to hold on to it.
Oh, that's my favorite. Yeah. That's my favorite.
But this is a good reason why you can sell it. Doesn't mean that you have to not ever invest in it again, but you can get rid of it, capture the losses, offset some of the gains that maybe you have throughout the year, just to benefit and improve a little bit, what your 1099 is going to show as far as at the end of the year for taxes.
Yeah. And I bet you, like any year, the high flyers of this year aren't necessarily going to be the high flyers of next year. I mean, are we going to get 1,000% more a growth in?
You're saying NVIDIA is not going to be important next year?
Are we going to get another, 100% growth in Google and, so on and so forth? I mean, Apple this time at points of this year was down into the 180s. Now it's 280.
It was lackluster.
Right. And so the real thing beyond rebalancing is also, does your investments now that maybe it's been a year, maybe it's been 2 years, maybe it's been since 2022 that you've actually looked at your portfolio to see if it matches your goals and objectives. And I think 2026 is going to be definitely different. I think this year was the year of the AI chip. I think next year is going to be the year of robotics, power for data centers, still data center infrastructure, software to run these different, supercomputers and all those things, automation, many things. I think there's a lot of opportunity in a lot of the things that, got some attention in this new industrial revolution we're in, but they didn't get anywhere near what the chip, right? The AMDs, the NVIDIAs, the Taiwan semiconductors, and anybody mentioning AI. I think that's over for next year. I don't think you're going to be able to just go, we're Meta, Facebook, and we're gonna invest into AI, and your stock goes from 300 to 600.
Right.
I think that plays over. So,
or Kentucky Fried Chicken, and we're introducing AI,
AI ordering, and so now Kentucky Fried Chicken stock, which is part of Pizza Hut and so on and so forth.
Well, it's Yum Brands, Yum or Darden.
It's Yum or Darden, one or the other. But my point is that what were the darlings this year aren't necessarily going to be the darlings next year. And
well, I mean, if you look at it, the returns of some of these darlings last year compared to this year, I think last year was actually better than this year. And primarily because we had the big dip in April and May, right? And if you look at the S&P 500 comparative to what it did in 23 and 24, I mean, yes, it's positive, but it's nothing like what it did in 23 and 24.
Yeah, I mean, overall, the S&P, I mean, barring anything crazy with the Fed, right? So just from a
which is next week,
from a news perspective, we've got, or economy perspective, we have the Fed, looking at interest rates again, which every month or every other month when this happens, I get a little vomit in my mouth just because I'm so sick of the Fed and the Fed having the power that they have. Do I think they need to remain independent of the executive branch? Yes. But
I think they need to go back to the old school days where they're not
anti-growth.
No, it's just they're not
anti-productivity.
No, they're just not commenting and going out, and giving their explanations or opinions, or it's like they comment. I was just listening to radio, and I forget who it was, but they were charting it, and they said, the markets are betting. At one point, it was like 80-90% of another rate cut in December. But then between, a 2-3 week period, there was Fed presidents that came out and were interviewed or commentated either on, the TV or social media or whatever. And from all of that commentary, right, it went from like 80-90% down to like 30%. Now it's back up to like 80%. Yeah. It's crazy. So I think going back to the old school ways where we don't need to hear every little thought that's coming out of a Fed president, right, at any given time and any point at any point in the week. Just have the Fed meeting. Maybe there's and then they have the meetings afterwards where they interview Jerome Powell and the committee and what have you. And that's it. And then we wait on to the next meeting.
Well, and if you think about it, how long has this mantra? I don't even know what a mantra technically is. I mean, the Federal Reserve Board and its monetary policy is given authority through congressional acts and laws. And so now our mantra is 2% inflation year over year as far as price increases and full employment. What does that even mean? I mean, if you're going to have a central bank that's part of trying to control your economy, then the only thing they should be trying to do is grow your economy. Their mantra should be pro-growth. That's it. It shouldn't be inflation. It shouldn't be unemployment or full employment, because if your economy is growing and booming, guess what? You'll have full employment. You'll have low inflation. You'll have wealth creation. People be able to buy house, on and on and on and on. So this mantra of, we're looking to crush the economy to get inflation down to 2%. And make sure unemployment, and it doesn't go hand in hand, and unemployment remains low, or therefore you have full employment, makes no sense. Because if you make it so people can't afford to do things, well, then companies' profits are going to go down. And if companies' profits go down, guess what they do? They don't hire and they lay off, and therefore you won't have full employment. So the mantra of the Fed needs to be completely revamped, rewritten. One of the main things is they shouldn't be a political body where they give these testimonies, mainly to the media now. Now they don't even give testimony, any worthwhile testimony.
It's like they can have their own channel.
Yeah, it's not a fourth branch of the government. And so I got off at a tangent, and really let's circle back on some of the things we'll talk about throughout the show, which is we've touched upon some strategy already, which is to rebalance, now before the year is up.
Look at tax loss harvesting.
Yep. Tax loss harvesting, potentially locking in some gains that, might not get any higher than they already are, especially if you have the chips that have just boomed inside of funds. And in fact, if you have funds, mutual funds, and you've got hundreds of thousands to millions of dollars, why? That would be my first question. I think you've graduated beyond the need for mutual funds, but really strategy wise, and we'll keep talking about this throughout the show, is, really positioning yourself from, updating your plan, having your risk be in alignment with your goals and objectives, and really repositioning
and your portfolio to be aligned with your plan. So if you haven't had a plan, or you haven't reviewed your plan in a long time, and you think there needs to be some updates and changes, then you should do that with your plan. And then you look at your portfolio and your assets and say, hey, is this lined up with my plan, or am I way off?
And by the way, before we go to break, if you call us now not now, I mean, we're close.
In the next 5 minutes.
You call us in the next 5 minutes. But if you give us a call to set a no obligation consultation, we'll review these things for you. And there's no charge to do that. There's no pressure. We'll take a look at what you've done. We'll give you a second opinion. If you don't have a plan in place, or it's been a long time since you've at least done a retirement a plan, we'll do that for you. We'll send you a questionnaire, which will start your draft of your financial plan, and we'll get that done for you as part of the no obligation consultation. And I highly suggest you do that while there's still time before the year is up. And we'll go to break. So keep listening to the Wise Money Guys. John Scamber and Giuseppe Visconti. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my partner,
Giuseppe Visconti.
And we were talking about the Fed and some of the strategies for the end of the year that are pretty important. But we didn't mention the meeting is actually next week. The decision meeting is
for FOMC,
next Wednesday.
Right.
So, I think it's going to be a quarter. Some think that it might not be anything.
Right.
And I guess it's just because there's a lot of disagreement now amongst the committee members, the Federal Open Market Committee members, that, some think there should be cuts and more drastic. And really Jerome Powell himself seems to think there shouldn't be any, because inflation is running at about, a little over 3%. By measures that we talked about last week, you can't even trust the data. So whether it's CPI or PPI or what's the PCE,
right?
Personal consumption expenditures, that's Jerome Powell's, I guess, barometer that he really likes to use, which is running a little over 3%. But again, I think they're focused on the wrong things. If you're worried about inflation, well, don't keep destroying the dollar. The real reason why there's inflation is because it takes more dollars against other currencies to buy the same good or service. If you strengthen your dollar and it takes less dollars, well, guess what? That's the true meaning of inflation. If it takes less dollars to buy something,
raise minimum wage.
Well, right. That'll solve everything. Just make it, $50 an hour minimum wage to, dig a ditch or flip burgers or whatever, to change a tire, work on a house, you name it. Well, $50 an hour, if you got skills, is pretty much going wage these days. Skilled labor, I mean,
depends. I mean, we're a little
even higher if you're like an electrician or a welder or
out here at least, in California for sure.
Yeah.
But
Yeah.
in other states, mid-America, probably that's probably too high.
But either way, I mean, so the Fed's, the FOMC is meeting next week.
Right.
The FRB, Federal Reserve Board Chairman Jerome Powell, is going to make a decision as far as Fed funds, which might even have the opposite impact. So a lot of the Fed cuts, if the industry, especially the powers that really control the bulk of the wealth in investments and banking, don't really feel it was the right move, interest rates could actually go higher because, right, the long-term treasury, the 30-year treasury could sell off, and then you'll see the yields actually go higher.
Right.
Same with the 10-year, and mortgages tend to follow the 10-year treasury. So treasury yields could actually go higher because money comes out of treasuries, goes into cash or goes into stocks or goes into something at real estate. And then you see a yield spike in the treasury market and mortgages, and i.e., loans.
Jerome Powell would hate to see that.
Yeah, no, he would love to see that, actually.
Especially if depends, but yeah, that would if that were to take place after they cut rates the third time this year, as they did last year, that's just going to put a world of hurt.
Yeah. So as far as the economy next year, I mean, this year was a pretty darn good year. I mean, I see, based on just really the momentum we have and the growth that we do have, and now that data is coming in about factories being built, manufacturing increasing here, hiring increasing to the manufacturing sector of just about every type of good and service. I mean, we could be in for a major economic expansion in the U.S. from a resurgence of, manufacturing being done here of goods and services. I mean, you look at things like Boeing, Boeing just, I mean, they actually forecasted for a long, and it's been a long time, more 737 sales and more 787 sales than they anticipated,
and less problems.
And less problems now. That 737 Max 8, whatever it was.
Well, there was some other
that was yesterday.
There was something else with a 787 more recent.
Well, don't you remember like I don't know if it was the 787, but literally a door blew off, we shouldn't be laughing.
That's kind of
scared to death.
That's kind of important.
The door,
especially since I'm flying out next week.
But that's the blue chip of blue chips, right? I mean, Boeing. It's like IBM.
Well, I think it's more of an icon of the U.S., right?
That's what I'm saying.
Because it's either Boeing or Airbus.
Yeah,
and you're flying on
Airbus is a foreign competitor.
Yeah, and you're flying on one of those planes. But I think as long as they continue to learn from their mistakes and build quality products like they used to way back when it was ran by literally engineers, their executive team was engineers back then until the 80s. McDonnell Douglas, merged with them, even though it looked like they bought them. And then McDonnell Douglas ran it based off of an Excel spreadsheet and just looked at profits.
Right.
Well, this is part of the reason why you have those problems with the 737 and 787.
Yeah.
Right. Because
you can't do cost cutting measures on safety when it comes to flying people places. Right.
Right. So some of them, they just have at some point in time, as things change, as things evolve and technology evolves, sometimes you just have to come up with a new design.
Yeah.
But what they've been doing is they've been taking an old design and then retrofitting it, and putting new pieces and new technology on old designs.
Well, if that wasn't a good strategy, then the 911 wouldn't be a good car, because the 911 is the same car. I know I'm going on a segue.
You calm down now.
You're just saying that they're just,
but
continuing with the same design over and over.
Not true. Yeah. Not true. Because the 911, how much bigger is a current Porsche 911 to a 1980s?
It's definitely
911.
Expanded both with.
The footprint's way bigger.
Yeah,
the footprint's way bigger. So that's the thing. The 787 the height of the clearance from the wing to the tarmac has been the same. They needed to redesign the whole plane to make it higher to fit bigger engines, but they didn't. That's why that's
another sector that I think you're going to see massive changes to. In fact, I was watching a story on the flight, the revolution in flight,
like drones and stuff, personal
drones, and now fully not even drones, fully artificial intelligence, automated combat
jets,
planes,
fighter
where jets. The thing about a drone is somebody's still behind the controls.
Well, I was talking about personal passenger.
That's going to be a huge. I mean, you look at whether it's Joby certainly, Archer. I think
Jettison or Jet, something like that.
I know who you're talking about.
Yeah,
but I think the way I think
you're talking military capacity,
military, but also personal transportation is going to drastically change. I think the robo transportation sector is going to boom. Starting,
have you been in one?
I have not yet. I have talked to friends who have been, and they're like, it's bizarre.
Yeah.
But once you're not paying attention,
I have friends
talking with
I have friends in San Francisco.
With, they're like, oh yeah, it's cool.
I have friends in San Francisco, and they use it all the time. Waymo.
Yeah.
It's just a car with a bunch of sensors and cameras and stuff, and it's just, bloop, bloop, bloop. It just makes its way through.
It's so crucial to rebalance and redeploy your capital. I mean, if you want to see, massive growth or growth in your portfolio, the things that we're talking about this morning is what's going to be the next wave of just gigantic gains from, revolutionizing just about anything that we do. And so I think we're at just a pivotal, crucial point from financial services perspective that, it's really going to take some skill and wherewithal and forethought to basically analyze and decide, how to address that so many people wish woulda, coulda, shoulda, right? Invested into the internet revolution. And they didn't. Well, now here we are. We're in the next industrial revolution, and there's just going to be trillions of dollars to be made. And it's a proven fact that people who work with professionals like you and I make far more money over time and on average than they do without the help and support and knowledge and skills of people like Giuseppe and I, who've been in the industry and have been at the forefront of some of these things. And I'll mention some of the ones that I started talking about 5-6 years ago and where those are today when we come back. You're listening to the Wise Money Guys, John Scamber and Giuseppe Viscani. Stay tuned. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scamber. I'm here with my partner, Giuseppe Viscani. I don't know why I keep tripping over my tongue, but we were
maybe it's too long, like my dog Lulu.
Well, let me say what we're going to talk about. We're going to talk about, and I mentioned, some of the things that I think are going to be more crucial next year versus this year, as far as where, big money was made this year still will be important next year. But I think a lot of the Mag 7, I think we'll see hopefully a little more broadening of that to where
it's not just dependent upon them doing well.
Yeah. But if you look at the S&P 500, the S&P 500 basically year to date here in December is up 16.6% year to date. And then you look at, our two main model portfolios, one which really takes stocks from the S&P 500 and then on a monthly basis is rebalanced where we select the model that we created, that Giuseppe created, selects on a monthly basis to potentially rebalance the top 10, or what we feel are the top 10 stocks based on the parameters that Giuseppe built and puts into the model out of the S&P 500 companies. And if we look at what that's done compared to what the S&P 500 has done, the S&P 500, as I said, was up 16.6, and the model portfolio this year of the S&P 10 with 10 stocks is up 36% year to date. Now, we always need to mention past performance is not a guarantee of future results.
Right.
But my point is I think it's going to be even more of a challenge.
And by the way, there's no Mag 7 names within those 10 names.
Yeah, isn't that interesting? So the Mag 7 really is what has fueled almost, I would say, 80% of the NASDAQ's indices growth.
It's a little more than a third of the weighting of S&P 500.
Yeah, but if you look at the return contributed of those 7 or 10 stocks, I mean, it's like 80% of the return. You pull out any of the Mag 7 and the Mag 10's returns out of the NASDAQ 100 or the S&P 500, and now all of a sudden, you're not at 16% in the S&P 500 anymore. And here's what's just super impressive. The S&P 10 model doesn't include any of the Mag 7 stocks, but yet it doubled the performance year to date.
More than doubled.
The year to date performance of the index, the S&P 500. So if you're thinking
the equal weight, just for reference, meaning that if you didn't put more of an emphasis on the Mag 7 or any one name, the equal weight S&P 500 index fund year to date is up under 10%. It's 9.5%, for example. So that's the difference between the weighting of the Mag 7, right, which is up, would you say 16.6?
Yep.
Versus 9.5, right?
Yeah. So if you're thinking you're going to do this part-time, meaning, or I'm just going to throw my money into mutual funds and I'm going to be fine next year and the year after and so on and so forth, you might. But wouldn't you want somebody like Giuseppe and I in your corner to do it for you instead, so that you can enjoy the wealth that you created?
Or maybe you've built your portfolio and originally it was all mutual funds, and you've gotten to a point where it's built big enough where now you have a larger substantial account size where you can go out and buy the direct investments yourself and create your own mutual fund.
Yeah.
Right? When you're starting your own account and you have maybe 10,000, 20,000, mutual funds make sense. ETFs make sense because that's the best way to diversify your assets when you're working with a smaller account size. But now if you've amassed 250, 500, 750, $1 million in the account, and you still have these ETFs and funds, not to say that they're bad, because we like some of them and use some of them in our
ETFs
portfolios
mainly,
and some funds,
alternative mutual funds. Yeah.
But now you can actually create your own, per se, mutual fund, right? Because now you can have direct investment of individual stocks. And here's one key of, well, why would I want that? Well, it's transparent. Number two, you could have put your money in a S&P 500 index fund and you're up 16.6, or you could have been more selective and figured out what individual stocks would I want to own, kind of like what we have in our model, right? And you're up 36%. And the other side of things, I just had a client review meeting last week, and they said, there's a few names in there that we don't agree with the businesses, the companies, for whatever reasons, right? Is it possible for us to substitute those names out and be invested in something else? 100%, because it's essentially your mutual fund. You could do whatever you want, right?
Yeah.
You don't have to own this, that, or the other thing. You can create it and customize it based off of, your goals, your timeline, your risk tolerance, and then also, your liking in regards to, maybe things don't align with you morally or politically or whatever the case may be.
Yeah. I mean, the reality is that our clients know what they're invested in. and why we have them in it. We just don't blindly put people in things that they don't understand what it is and why it makes sense for their portfolio.
Well, I got a great example. I just talked to one of my old counterparts. He's also a financial advisor, works for another firm, a large firm, and they use a lot of SMAs. SMAs, just separately managed account. This is very common amongst other advisory firms and firms that we used to work for, is they usually have their own portfolios that they run with their portfolio managements, whoever their brand name is, whatever big firm they are. But then they also have access to third-party funds and portfolios out there as well, a lot of big names. So there's one that they touted because it just had a killer couple years, but part of that is because it had NVIDIA in there and some of the other Mag 7 and what have you. Well, this year it got hit really hard in April, and it's never recovered, and it's been underperforming the S&P 500 like on a pretty big margin. And he's kind of frustrated because it came down through kind of management, right? And then the wholesalers come out. And that's the biggest difference is, a lot of times when you're working with somebody or a firm, they'll put you in XYZ portfolio. It could be their own brand name, right? Like there's plenty out there, Merrill, Fidelity, Wells Fargo, T. Rowe, whoever. And then they have a lot of third parties and say, oh, there's a third party separately managed account. We're going to put you in there. And they've done this, that, and whatever. But sometimes they change. They can change the manager. They can change the strategy, whatever the case may be. And then all of a sudden it's just going off kilter. And then you're saying, hey, what's going on with my portfolio? And they'll say, well, okay, let me go ahead and call them to figure out what's going on, and I can get back with you.
Yeah. I mean, isn't that crazy? So, and there's two things I want to mention about that. First of all, it is common. I mean, your advisor and you're working at Fidelity, or you're working at Schwab or Wells Fargo Advisors or Morgan Stanley, or it doesn't matter. And you're charging an advisory fee.
Mm-hmm.
And then you put people in investments that also have embedded fees, like the separately managed accounts. Hire money managers like Giuseppe and I, that we're going to charge a fee, and then you're going to pay the advisor a fee too.
Yeah.
So when you work with us, you're really cutting out the middleman, whether you're paying for a separately managed account portfolio or model that has a fee, and then you're paying your advisor a fee, or you're using mutual funds and you're paying an advisor who's putting you in these mutual funds, and you're paying the advisor a fee. And again, you're paying embedded fees, advisor management and expenses and fees inside of the mutual fund. So again, when you have, means, hundreds of thousands to millions of dollars, why you would be paying, an advisor to then sell you somebody else's, model or fund makes no sense.
Right.
And so many times we find that
well, it makes sense for the advisor.
It makes sense for the advisor because they don't have to do anything.
And it's not that there's not good portfolio managers out there. There's plenty, but the advisor, they have to kind of pick and choose what they do with their time. Number one, and number two, they may not be capable, or they may not be approved to be able to be a discretionary manager like we are. And that's exactly what we do here. That's what we are. We're representative of One Source Wealth Management, our firm, and we are discretionary managers, fiduciaries to try and look out for the best interest for the client. We're not beholden to a brand name or some certain corporation or whatever. We're agnostic to it. So we can put whatever we want in your portfolio and manage it as such based off of, like we had talked about earlier, your plan, whatever your plan is set out to achieve over time to get you from point A to point B. That's what's important to us. And then that's what we build the portfolio around. But then you're talking with the actual individuals that are pulling the levers and pushing the buttons, throughout time. And as time changes, things change in life, things obviously change in the market and the economy, then we make adjustments to the plan, and then we make adjustments to the portfolio.
Exactly. And so at the end of the day, performance does matter. Cost does matter, but really is what's being done truly in your best interest? Is it transparent? Like you've mentioned, and is it simple, right? Our business model is simple. we work with people who, have built wealth, whether it's, through self-employment or W-2 employment. They've saved, they've done everything right. And now, you deserve the same sort of effort that it took you to get to the wealth that you have, to maintain that wealth, grow that wealth, pass that wealth on, to whatever your aspirations are in for the next generation, or to create your legacy, so on and so forth. And all we do is planning and money management. That's it. And so, I guess right now I should say that, and I haven't said, we'll absolutely do a review of your portfolio, make some recommendations, especially from a rebalancing, from a risk perspective, from a cost perspective. We'll do that. Call 916-967-3500 to get on our calendar. There's still a few weeks left, obviously, in the year, so there's still time to do some rebalancing and maybe revising of your plans and your financial plans for next year. And just to give you another example, so we talked about our growth model, the S&P. Why
don't we do that when we come back?
Yeah, we'll talk about our other model and give you some more examples of just some of our results when we come back. You're listening to John Scambri and Giuseppe Visconti. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambri. I'm here with my partner, Giuseppe Visconti. And let's talk about our other model. And you might be thinking, well, that the one we were talking about, wow, that sounds really risky, really aggressive. It is. It's an aggressive stock portfolio, but it's designed for whatever portion of your portfolio you want to have in stocks.
Designed for growth.
It's designed for growth, but we also have a more conservative, more conservative model called we call it the core. It's a growth and income model. We call it the
Equity,
one source core
and growth
equity,
model.
Income, and growth model. And again, if we go back to what the weighted S&P year-to-date return is, which is just under 10%,
or even the weighted S&P,
and that's all stocks, which could and probably has a standard deviation of 17, 18, percent, somewhere around there.
Mm-hmm.
And then you look at the core model that, once again, it's now more stocks than 10. It's 30 positions instead of 10 positions. It's rebalanced monthly as well.
Well, it's not rebalanced monthly. It's
reviewed monthly
to see if there's any changes that need to be made, and if so, then it's rebalanced at that point. But
yep, and here we are. Its return year to date, and again, past performance isn't a guarantee of future results. It doesn't mean it'll have as good of a year next year as it did this year.
Right.
But if we even look at the 3-year track record of both of these, they're both double digits each year. So, but again, that doesn't mean that's what it's going to be in 26. I think 26 is going to be a good year for a variety of reasons, some that we've already mentioned.
Here's the important part that you left out is that there's a heavier bias on this portfolio of dividend paying stocks. So the first model, which is up 36%, that's just pure growth. That's just going after the gusto, trying to beat the S&P 500. Whereas this one is 30 stocks, but the biases is there needs to be a good portion of it of dividend paying stocks and getting paid for your time, which makes sense for a lot of our retirement clients.
So this portfolio does have a little lower risk measure, a little lower volatility and standard deviation, as I already mentioned, than the S&P 10 model, but the performance is still there. It's still double digit with a dividend. And so year to date, it's at 18.43% and pays on top of that, has paid out a 3.22% dividend. So the total return, is closer to 23% than it is, 18%, which is still more than double the weighted S&P,
equal weighted,
the equal weighted
yeah.
S&P 500. And so now we're not saying that because we want, everybody to come in and put all their money in that and so on and
Can
so
you
forth.
Can you at least pat me on my back?
But okay, that's one of the reasons why we're saying it's a great year. And if you had mutual funds, you had, broad-based stock portfolios, you probably had a good year as well. But it's, how are you going to do if next year isn't as good? Are you going to have the proper diversification outside of mutual funds where you have dividend paying stocks? You have fixed income investments. There's fixed income investments that still pay double digits. Do you have those in your portfolio? Okay. Do you have alternatives? Do you have hedge funds? What do you have in your portfolio that if the year isn't great next year, did you have any metals? Did you have any crypto exposure? So on and so forth. So there's so many different categories of investments.
Crypto's got hit.
Crypto
recently.
had an awesome run, then got hammered. Now it's coming back up again. It really follows kind of the NASDAQ.
Yeah.
If you think
has
about
a pretty
it,
close
at least
correlation.
Bitcoin has a really close correlation to the NASDAQ. But my point is that there's more ways to make money than just stock and stock mutual funds and stocks ETFs. The key is knowing what your objectives are, knowing what your return needs are, and then finding the least risky way to achieve those return needs. And so having a number, having a strategy, having a benchmark to your wealth is crucial to not taking on more risk than is needed. And that then goes all the way circling back to the beginning of the show, the importance of having a financial plan and having one that's a living, breathing document. So, I mean, I worked for Ameriprise for about 5 years, long time ago, more than 10 years ago. And planning was their big thing. But they would sell plans that would come in these fancy leather bound books, right? And be literally 100 pages of stuff.
Encyclopedia Britannica.
And most people wouldn't even read it.
Yeah.
And the point of the plan wasn't to just impress people. And I'm saying that now. The point of the plan now isn't to impress people with some fancy actual book. No, it's to create a working roadmap, as you like to say, Giuseppe, to, really benchmark where you're at each year, especially the years in retirement, to make sure that you never run out of money. And no matter what those goals are, no matter what those risks are, that you're put in the best possible position for success. Now, it doesn't guarantee things, but it certainly makes life less stressful to have a plan, to have two professionals like Giuseppe and I working with best in class, platforms. I mean, we love the Charles Schwab platform. That's the main one we use for our clients. And having those resources behind you in a written plan that's reviewed and updated regularly, where your portfolio is actively managed by two guys who have been in this industry for a combined almost 50 years now. So we're battle tested, I like to say. And if that doesn't sound like what you have and what you're doing, and you're not working with a fiduciary, and you have no idea what your true cost of things are, you have no idea if you're truly diversified, you don't know what you should be in for 2026. I was going to mention just some of the things that we mentioned a couple of years ago on the growth side, like Palantir and CoreWeave and UiPath and Symbiotic, and then on the non-tech side, Frontline, Albemarle, and on and on and on. And there was copper companies and so many things that we talked about on this show. Gold. I mean, I started telling people to buy gold when it was, in the high 1,000 range. And here we are in the low 4,000. And I think it's going to 5,000. Should you have gold in your portfolio? That's a great point. If so, what type of gold? Should you have gold mining stocks? Should you have gold tracking stocks? Should you have physical gold? So on and so forth. I mean, Those are all the things that could potentially be in your portfolio. So let's just review real quick because we're out of time. Rebalancing for the end of the year,
tax loss harvesting,
which I always kind of think that's an oxymoron, right? Okay, well, I guess if you have some positions that have some losses in it, you might as well use them to your advantage. But it's not a strategy or a goal to have, investments that are losers. Yeah. But
if you have losers, take advantage of it. That's part of your rebalancing for this year. And then you can do the rest of the rebalancing next month because it's a new year.
Exactly. So have a plan, update your plan, look at, a portfolio review before the end of the year. More importantly, call 916-967-3500 for a no obligation consultation. I hope you've enjoyed listening to John Scambray and Giuseppe Viscani, the Wise Money Guys. Have a wonderful Saturday and come back and give us a listen next weekend.
Bye. Have a great weekend.